Welcome to another one of Professor Karn's accounting videos. The purpose of this presentation is to discuss the statement of cash flows and how that becomes another primary financial statement that corporations need to prepare. If you think back to your accounting principles course, at the very beginning of that, we really went over, or you would have went over 3 different financial statements that would need to be prepared, and they were the income statement, the statement of owner's equity, and the balance sheet. And we still see all 3 of those today. The statement of owner's equity may be in a little different form. If you're dealing with a partnership, you would have a statement of partner's equity. For a corporation, we've seen statement of retained earnings would be important, as well as you could do the stockholders' equity section of the balance sheet. But specifically now we need to add another one of those financial statements, and that is the statement of cash flows. So really, what is the statement of cash flows and why do we need to do it, prepare it? Basically, we have to think about the cash flow of the business. And we think about cash receipts, meaning those are inflows of cash into the business, and also cash payments or cash outflows for the business during a particular period. And when you think about it, obviously cash overall as an account is either going to increase or decrease during the period. And when you think about how you're going to prepare this, again, it's going to be for a time period. So for the month ended, for the quarter ended, for the year ended, just like an income statement would be prepared. All right, so let's go into a little further detail as far as why would we be doing this. Again, when you think about it, net income certainly is an important figure. Just remember, though, that net income from a cash flow perspective does not equal the change in the cash balance. The reason behind that is because we use the accrual basis of accounting, meaning that we record revenue when revenue is earned, not cash payment for revenue is received. And then we also record expenses when we incur the expense, not when the expense payment is paid out. So we really have to figure out, this important piece here. The reason we do that is we got to be able to predict future cash flows. You think about, let's say that we're considering, the corporation is considering expanding operations and adding on to their warehouse facility. Well, you're probably going to have excess cash on hand to do that. And if you don't at the moment, that's something that you would need to address. That's just one example, a pretty straightforward example. You may be wanting to evaluate management. How well are they managing their cash flows? Are they spending money frivolously on things that aren't really adding anything or any type of enhancement to generating revenue for the business? That would be something we want to look at. And obviously, we need to always be able to pay our debts as they come due. We need to be liquid and have those debt payments on time. Give you an example. Let's say we have to make a bond payment. It's going to mature, and we had a $5 million bond, and we need to have $5 million in the bank next month to pay that when that becomes due. You've got to have that cash on hand to be able to do that. So something very important. And then if you want to offer and pay cash dividends to your shareholders, you obviously have to have the cash to be able to do that as well. So what you're going to see in these problems is basically a breakdown for the statement of cash flows into 3 distinct sections. They are operating activities, investing activities, and financing activities. And you would have each of these sections specifically listed out on the statement of cash flows. Now, let's talk a little bit about each separate area. So operating activities are pretty straightforward. It revolves around the day-to-day operations of the business and how they incur expenses and generate revenues. So this is probably the most essential and key piece to this. It depends as we move forward. You're going to see how we're going to prepare this. It could be up to 2 separate methods, but this is probably the one that you're going to really want to pay attention to as far as really how are we generating cash inflows and outflows from. Now, for the purposes of our particular course / session here, there are 2 different types of methods as I discussed earlier. One is the indirect method, which we will certainly be taking a look at. The other is the direct method. We will not be using that, so that's why there's a big X through that method. The indirect method, though, basically is going to be pretty straightforward, and that is we're going to take our net income and then we're going to make adjustments to reconcile that net income to the net cash provided or used by operating activities. And again, we will be able to see a specific chart here that'll help us use account relationships to determine what the changes in cash are and how to address those changes. Now, let's think about this, and the chart on the next page will give us a little bit more detail. Again, we know we have to adjust net income based upon the changes in our current assets other than cash, as well as our current liabilities. So we really have to understand that we're going to be taking a different perspective here. So let's just look at these examples I provide here. It says, sales on account generate revenues that increase net income. So let's think about this. In that particular scenario, we would debit accounts receivable and either credit sales revenue or service revenue. Well, in that case, cash was not involved in that particular transaction, so that does not apply to the statement of cash flows. So we have to address that, because think about it. If it's accounts receivable, the company is owed the money by the customer, so the company has not yet collected the cash from those particular sales. However, sales revenue or service revenue, all of it is earned when we have earned that revenue. It is recorded at that time, so the net income figure would reflect that, but we did not collect the cash, so it cannot go on the statement of cash flows. Think about accrued expenses. Let's say that we have salaries expense that we have to debit, and then we would credit salaries payable because we owe those salaries. Well, no cash was done there, used in that transaction. Typically, that's an adjusting entry when you have to accrue salaries expense at the end of the accounting period, and you're not going to pay it until the next accounting period. But guess what? The salaries expense was recorded because we incurred the expense, but cash was not used because we owe those salaries and we've not yet paid the cash to the employees. So this is the chart that I was speaking about. This I would definitely print out potentially and just have with you when you're going through these problems. It's really a good tool when we think about how we're doing and preparing the operating activity section. So let's go through this. The first item is depreciation, depletion, and amortization expense. Notice that we have to add those back in because remember, depreciation, depletion, and amortization are non-cash expenses. So they were subtracted on the income statement. So the net income figure has them removed, but guess what? Because they're non-cash, they have to be taken back out of there. So in order to cancel out them being subtracted, we have to add them back in to cancel it out. Gains and losses on disposal of long-term assets, those are things that also would appear on the income statement, and a gain would obviously increase net income and a loss would decrease net income. But because long-term asset disposals will be dealt with in another section, specifically the investing activity section, we have to, if it's a gain, subtract it out to cancel it on this particular area in the operating activity section. And if it's a loss, we have to add it back in to get it to cancel out as well. So we will address these things in the next section, investing activities. So if we would not take them either cancel them out in either fashion, we would double count them. So we don't want to do that. And as we saw up above, if we have accounts, talks about increases in current assets other than cash, take accounts receivable, as we just talked about in the previous slide, for example, we would debit accounts receivable and credit sales revenue. Well, that is not something that we want to include, so we'd have to subtract that out. If we decrease our current assets other than cash, say that accounts receivable decreases, well, that means that we got the cash in, so we'd have to add that. And then, as we discussed earlier, if, say, salaries payable increased because we debited salaries expense and we credited salaries payable, no cash involved there, we'd have to add the increase there. And then decrease in current liabilities would mean we did use the cash, so we'd have to subtract that there. It means that account, say if we debited salaries payable and credited cash, cash would be going out. Okay, so I would definitely have this chart with you as you go through the problems. Moving on to the second section, the investing activities area. Again, most of these things are going to talk about the inflows and outflows from selling and purchasing long-term assets. Again, this is going to be specifically cash payments and receipts from performing those activities. Here are the different things that you're going to see. You could have planned assets, you could have investments, you could potentially have notes receivable, if that's a case where you're getting certain things, payments in or loaning money out. That could be problematic as well. We'd have to deal with that. Again, one thing here that you definitely want to do is use a T account. That may assist you, to decide whether or not there was an acquisition or disposal and how to address that. Our final activity is financing activities. Keep in mind that basically when you think about financing activities, these are the inflows and outflows that talk about long-term liabilities and stockholders' equity transactions. These types of activities include issuing stock. Obviously, if you issue stock, you're probably going to get potentially get an infusion of cash. Now, you could issue stock for other reasons, and we'll address that in a moment, how we'd address that. But if you issue for cash, that would be included. If you pay dividends, cash is going out, so that would be something we want to deal with. If we buy and sell treasury stock, cash going in if we're selling it, cash going out if we're buying it. And then if we borrow money and then we have to either get the money that we're borrowing coming in, or if we're paying back, things like notes payable, bonds payable, these transactions would all be included here. Now, the one other thing that you may have to do is sometimes they do not give you the amount of cash dividend payments in the problem. They may not. You just may have to realize that you would have to solve an algebraic formula. Remember, our retained earnings formula is to take the ending retained earnings equals beginning retained earnings plus net income or minus net loss minus dividends. So you would just make dividends the X variable and be able to solve for that. One thing I'll put on here is make sure that you realize that, again, this would be something that this is an either or. You don't do both of those. You can only have net income or net loss. So you either add the net income or subtract the net loss there. And then you would just make dividends your X. If you had your beginning, if you had all the numbers, and then you just say minus X and then solve for X to get your dividend amount that was paid out. Now, the other thing that I brought up in the financing area is, what if you issue stock for land? Well, is there cash involved in that transaction? The answer is no. I could issue stock for pretty much anything. It doesn't have to just be for cash. So remember, we're worried about cash on the statement of cash flows, inflows and outflows of cash. So if I do issue stock for the purchase of a building or the purchase of land, those types of transactions would be called non-cash investing and financing activities. The thing that you have to realize is that this would be prepared in a separate schedule at the bottom of the statement of cash flows or in the notes to the financial statements. Typically in the problems that we would do, it would just appear under the statement of cash flows on the problem sheet that you are working on. Okay, let's try a little exercise here, and I'll give you a second or two to kind of work through this as we do it. It says identify each item as operating O, investing I, or financing F, or non-cash N. So we have to figure out where it's going to go. Okay, so number one, it says cash receipt from the sale of equipment. Okay, we know it's a receipt, so it will be an inflow of cash, so we know it's got to appear somewhere. It would not be in the non-cash area. Now, sale of equipment would be the sale of a plant asset or long-term asset. So, in this particular case, it would be an investing activity. Second one, cash payment for salaries. Cash payments would be an outflow of cash, so we know it's not non-cash. And then we know salaries would be something that we would do in our daily operations. So in this case, it would be operating. Third one, cash receipt from the collection of a long-term notes receivable. Again, cash receipt, cash inflow, so we know it's not a non-cash issue here. We know long-term notes receivable would be something that would kind of clue us in, knowing that it's long-term. It would be found in the investing activity section. Next, we have purchase of equipment in exchange for a notes payable. So in this particular case, equipment is coming into the business, and we're just signing a notes payable in exchange for that. So if you do look at this, there really is no inflow or outflow of cash because the equipment came in, cash did not. So in this particular case, this would appear where? In the non-cash investing and financing activities. Finally, we have our cash receipt from issuance of common stock. And we discussed this earlier. We know cash receipt's an inflow. We're issuing stock. So in this particular case, this would fall into the financing activity section. All right, so what we want to do here is take a look at a problem. And what I'm going to do is just prep it with this one slide. And then I'm going to go over to Excel and work our way through a problem so that you can see how this works. The great thing about this is that, did you know, we know the answer to the problem before we even begin, because the answer in these problems for the statement of cash flows, when you prepare it, always has to be the ending balance of cash. So the great thing about this problem is, you know, if you do not get as your answer the ending balance of cash, that there is a problem there. So again, we have to break it down. We have to do the operating activities section. We have to make adjustments to reconcile our net income to our net cash provided or used by operating activities. We have to prepare our investing activities section and our financing activities section. I know I mentioned this before, but again, it's a good thing to kind of reinforce it here before we start the problem. Again, we need to think in a different mentality, and that is a cash flow perspective. Inflows, outflows, and you will need to use your accounting skills from the past to be able to understand some of the relationships that we have here. So let me take a moment here. This concludes this presentation as far as the PowerPoint is concerned. Let me come back here with you in a moment after I get the Excel thing brought up to us here. Okay, so let's take a look at this problem. Again, you can get to this Excel document either on the online platform, My Accounting Lab, or whatever one that we're using for this particular session. All right, so it says accountants for Carlson Incorporated have assembled the following data for year-end December 31st of 16. It gives us the current assets of 2016 as well as the 2015 figure for that, as well as current liabilities. It gives us the transaction data, and we need to prepare Carlson's statement of cash flows using the indirect method, include accompanying schedule of any non-cash investing and financing activities. Okay, so let's do the first thing here by putting in our heading. So we know this is accountants for Carlson. This is the statement of cash flows, and it is for the year ended 12/31 of 16. All right, so let's do this. Let's make sure that we know the answer to the problem before you start, and hopefully you know that that is the $89,200 that we have there. Again, this is the older year, the 15. The 16 is the current year, and we would take the ending balance of cash as our answer, in this case, $89,200. Okay, so let's go ahead here and see how this is all going to start off. The first thing we're going to do is have our, I'll make this a little bit bigger here for us. Let's liven this up so we can see a little bit better. All right, let's see here. Helps if I get out of the block there. All right, did that help? Let's see. There we go, and I think we can still see everything. Okay, now, we know that we have cash flows from operating activities as our first section. And we start off with our net income. Just a note here as I'm filling in these blocks. Again, this is a financial statement. These columns here have nothing to do with debits or credits, so don't worry about that. This is just math computational columns. Let's go ahead and put our net income all the way over. We know our net income, they gave it to us. It's right here. We're going to check off all these numbers as we use them. 69,500. All right. Then we have to do, like we said, we know that we're using the indirect method. So we know we have to make the adjustments to reconcile net income to net cash provided by operating activities. All right, so let's go through. I'm going to go back to the PowerPoint and just be able to kind of bring this chart up. Again, I told you that you should definitely use this chart here. So the first thing let's look at is, do we have any depreciation, depletion, and amortization? And we have to add that back in. Okay, so let's see what we got here. Go back to Excel. So notice here in our transaction data, we see right here we have depreciation expense. So we'll start off with that item first. Bring that over here. We have depreciation expense, and again we're going to add that in, so that's 21,000. And let's just make all of these things consistent here so we know that we have enough space, and we know that they are going to be, we don't need to bold them there, so let's unbold them. Okay, now. All right, so then the next thing we have to look for is, do we have any gains or losses on disposal of long-term assets? So let's go back to our data here and go up here. Let's check off our depreciation expense. So we got that all squared away. Now, we do see that we did have a gain on the sale of the building. So remember, because that was added in on the income statement and is part of net income, we do not want it there, so we have to do the opposite and we have to subtract it. So let's put a check mark there, and we'll come down and subtract that out. Gain on sale of building. Now, if it's an inflow, it'll always be positive. Anytime it's a subtraction that we have to deal with, if it's something we're adding back in, be positive. If it's an inflow, it's positive. If it's a subtraction, it's negative, and we would put it in parentheses. So, like we added the 21,000, it's a positive number. We're subtracting this out, so this would have to be in parentheses. All right, so we don't have anything else as far as any losses or any additional gains on sale of long-term or disposal of long-term assets. So now we can go down into our current assets. So we know we have to subtract out any increases in current assets other than cash, and we have to add in any decreases. All right, so let's go here and see what we have. Let's go down to up into our data here. So we know these two things here, these are things that we have to address. Those are two current assets other than cash. So if you can see this, accounts receivable went down, so we know that was a decrease, and we see that merchandise inventory went up. So, all right, so let's take a look and identify each of these first. So we know that we have a decrease in accounts receivable. Okay, and the numbers for that would be, we got to take the difference, which is 68,800. Now remember, for any decreases in current assets other than cash, we have to add them back in, as we can see here. So this will be a positive number. So let's go back and do that. We would take the 68,800 and we would subtract out the 64,600. Okay, 64,600. And we get a positive 4,200 that we have to add back in because accounts receivable went down. The reason that is because think about it. If account receivable decreased, we have to realize that we collected the cash. Cash would be debited, and we would credit and reduce accounts receivable, so cash came in, so that's why we are adding it here. All right, now we also have the opposite approach for the merchandise inventory, so we're going to simply then subtract the increase in merchandise inventory, and again, you can see from our chart here that we are going to subtract there. Okay, so let's go ahead and do that calculation. Oops, we don't want to be doing weighted average cost there. For inventories, we're statement of cash flows. All right, so now let's go back here. We have 77,000 and 85,000, so that's a pretty straightforward transaction. So I'm going to go ahead, because I'm doing an increase and I have to subtract, I'm going to make the number be negative. So 77,000 minus the 85,000. And you can see we have to subtract 8,000 there. So let me go back up to here to these two numbers, actually these four numbers, and we'll go ahead and we will check all those off there as used. All right, now let's take a look at what we have to do when we have current liabilities. If we look at our PowerPoint here, you can see that if they increase, you add them. If you decrease, you subtract them. All right, so let's go ahead and see what we have here for our current liability section. So we have two numbers here. We have actually two accounts, not two numbers. Accounts payable and income tax payable. Notice that accounts payable went up over the year and income tax payable went down. So we will add the increase in accounts payable and subtract the decrease in income taxes payable. So let's go ahead and put this here. Increase in accounts payable. And that would be simply to take the 57.5 minus the 55.4 plus 57.5 minus the 57. Oops. Let's make sure that we're correct here. 55.4. You can see that we get 2100. And then we simply have to go back up here and we have to use, we got these taken care of here. And we have to take the 14,700 minus the 16,200, and that will be our decrease in income tax payable plus, again, we're going to make sure we get the right numbers, 14.7 and 16.2. So 14.7 minus the 16,200. Oops, formula mistake there. Let me correct that. Sorry about that. Plus. And there we are. 1,500 is what we subtract. So if you think about it, accounts payable went up, so we did not use cash. We used, it was increased, so we have to make sure that we add that back in because we subtracted it out earlier. The expense increased, but the cash was not paid out. And then think about it, if income taxes payable is decreased, we're actually paying it off, so therefore we have to subtract that as an outflow. Okay, so now what we want to do, let's draw a line all the way across here. And if we total all these things up, the 21 minus 2 plus 42 minus 8 plus 21 minus 1,500, we get 15,800. Now here's a mistake that students make. Please be careful here. The 15,800 is not the answer. You have to remember that you have to add this total, whether if it's positive you'd add it together, or if it's negative you would subtract it. That will be your answer. You got to make sure you deal with that with net income. That's why I put net income all the way out there first. So now we'll combine these two. We'll just go ahead and do a quick sum here. I'll do sum, and we notice that we get $85,300. That is our net cash provided by our operating activities. All right, so that gives us the answer. I'm going to highlight that in a color here, so we know that's one of our answers. Let's do that in yellow. All right, then we have just two more sections that we have to concern ourselves with. The next thing we have to look at is our cash flows from our investing activities. Okay, let's see what we got here. All right, so again, remember that these particular activities revolve around things like buying or selling plant assets, notes receivable transactions. So let's take a look up into the top here. Do we see anything here with this particular thing, buying or selling plant assets? Let's go down the list. I see right now, right here, as we go down right away, obviously issuance of stock, common stock for cash is not something that's relevant here. But I do see purchase of the equipment with cash. So that would be something that we'd have to deal with. Now, if we purchase the equipment with cash, Obviously, we're using cash, so that would be an outflow. So again, let's go ahead and put that here. We'll say acquisition of equipment for cash. So that would definitely be a subtraction because that would be an outflow, and that was $73,000. So we took care of that. Now, if you recall, up in the top part here, we know that we had a gain on the sale of a building, so we know that we have that somewhere to deal with. So let's look at that here. So notice that they give us not only the gain on the sale of the building right here that we already checked off, but we also have the book value of the building that we sold. Okay, so let's look at that here for a moment. Recall back to your previous studies of accounting. Remember that book value of an asset is your cost minus accumulated depreciation. And then if you have a gain, that you would have to add the book value to the gain to get the sales price. So in that case here, we're going to simply say, and we're going to say, obviously, cash receipt from the sale of the building. Okay, and that would be, I'm just going to put, this would normally be here, but I'm just going to make sure I understand. We'd have to take the book value plus the gain. That's how we're going to get this in this case. So we had the $55,000 amount plus the $2,000. Okay, so $55,000 book value, $2,000 gain. So we know that we received cash of $57,000. Now that you have to do that calculation if that's what they give to you. Now, if they just told you the cash received from the sale of the building was X, you would use that figure. So just kind of be careful there as you're working through the problems. All right, let's go back up to our chart. We've used this number now. Now, just because I'm checking off these numbers doesn't mean I'm going to use every one. Sometimes they may give you misinformation. Sometimes you may use them all. Just kind of keep that in mind. Now, let's look at this one. Acquisition of land here by using long-term notes payable. Well, land would be something that would be a planned asset, but notice we issued long-term notes payable, so that's not going to go here because that would be considered a non-cash investing and financing activity, so we don't have to worry about that yet. Payment notes payable, that's nothing to do with long-term assets as far as us paying that off. Dividends, nothing there either. And then obviously issuance of notes payable to borrow cash, not something that would be something that would go in the investing section. All right, so now I think we're done with that. Let's draw our total line here to figure out the total here. Now, unlike up above, we don't have to do an additional calculation. We simply add the two numbers, really take 57,000 and subtract 73. Obviously, you can see we get a negative number here, and that's 16,000. Now, what does that mean? Well, in this case, and it's perfectly fine, it's going to be the cash flows not provided by, because it's not a positive or it would increase, it's going to be the net cash flows used for investing activities. So what you want to realize here is the fact that even though it's a negative number, it's not a bad thing. You just use some cash to help us, to help along the way with the investing activities of the business, which is a perfectly fine thing to do. All right, so that one we can highlight in another color. That's the second of the three activities we have to deal with. Oops. Let's go here. Let's highlight that one in orange. And the final one is the cash flows from financing activities. Okay, and I'm going to actually be consistent here and put a colon after it after I did the first two. All right, now let's go back up and start looking at pretty much everything else that we have here, with the exception of our cash numbers is going to be relevant here, I think. So the first one we have is issuance of common stock for cash. So cash would be coming in, so we'd have to add that in. So let's do that. That would be a cash receipt. cash receipt from the issuance of common stock. And that's a positive because cash is an inflow coming in of $38,000. All right, so we got that one squared away. Let's scroll back up here and see what we got. We know this is non-cash, so let me just put NC there. So we know that that's going to be something. Let's make that a little bit more clear here. NC, non-cash. All right, now let's go to payment of notes payable. Well, guess what? If we pay off notes payable, then we know that that's going to be an outflow because we're paying it off and giving them money. So that will be a negative number. So that would be a cash payment of notes payable. So we know that's negative 51,100. So let me check that off now. So you got cash payment of notes payable, 51,100. So that's good. Now, the next one is payment of cash dividends. Obviously, you're paying cash out. So again, that would be an outflow and another subtraction. Cash payment of dividends. And that was 46,000, so that would be a negative number. So you can see that we just checked that one off. And it looks like the only thing we have left to do is deal with the issuance of notes payable to borrow cash. Well, that means cash would be coming in for 61,000. So we'd have to add that in here. That would be a financing activity that would help us. So cash receipt from issuance of notes payable. And a positive number, again, that was 61,000. Okay, so we check that off here, and we know that looks like we've got everything addressed here with the exception of the non-cash investing and financing activities for the acquisition of land by issuing a long-term notes payable. Okay, so now let's add this up. Again, 38 plus a negative 51,1 plus a negative 46 plus a positive 61,000 comes out to be, let's put a total down here, a little line. This is a positive number, and it comes out to be 1,900. So this would be our cash flows. Again, this is a positive number, so this would be cash flows provided by financing activities. And we can highlight that one here in a different color. Let's do light blue for that one. All right, so we do that. Now, what we have to realize here is that once we figure all three of these things out, we're ready to solve the problem. We already know our answer is hopefully going to get us to be 89,200. Again, I'll star that again. We filled that out up here earlier, but let's see how we do. All right, so what we're going to do now is we're going to sum all of these things up. The three that we just calculated, the net cash provided by operating activities, the cash flows used for investing activities, and the cash flows provided by financing activities. We add all those things up, and we get 71,200. That represents, and we put a line here to show that we're totaling these things up. This signifies the net increase. Now, if it's positive, it's a net increase. If it's a negative number, which it could be, and you would just write it like this: net increase or decrease. There we go. I finally got it spelled right there. In cash over the year is $71,200. Now, what do we have to add to this number? Well, we're going to add the beginning balance of cash, the cash balance that we had on 12/31 of 15. So we know that they gave us that figure, really the only figure we haven't used in this problem yet, and that was $18,000, as you can see right here. So I'm going to check that box off, 18,000. Check that number off, not a box. All right, so 18,000 right there. And notice that when we add these two things together, notice that we get $89,200, which is exactly what we think the answer should be, and what it should be. This is the cash balance on 12/31 of 16. So that completes your answer. You would draw a double line underneath of that to signify that that is your answer. And in this particular case, you can see that we are in agreement with what we should have. So again, if you didn't get the 89.2, then obviously something would be incorrect. So it's a great thing to be able to check yourself. So that completes the statement of cash flows itself. Remember though, we still have to do underneath of this a separate non-cash investing and financing activities section. And we have one of those, and that again was the only number that we really didn't address, and that was this one right here. I'll check it off now. We've got all the data used. Again, that may or may not be the case in some problems. Don't think you have to use every number. Sometimes you may or may not. It just depends on what data they provide. So we know we have the acquisition of land by issuing a long-term notes payable. And there's only one, so it's 122,000. And we just know that there's nothing to add to that, but we should still total it out. Total non-cash investing and financing activities comes out to be the 122. Okay, we would just put a line underneath of that. There's nothing really to add to that, but you're still do a double line under here first, so we don't have to go back and keep doing things. It's already there. There's the double line, and there is the total line here, just one single line there. There we go. So now you've completed both your statement of cash flows and your corresponding schedule of non-cash investing and financing activities. And that completes this problem. Keep in mind as you work through them, sometimes you need to calculate extra things. Just remember, the great thing again is you can definitely see your answer before you start. Good luck on the problems.